makers and market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manus Crenny in Dubai. Here's what's coming up on today's programme. China delivers the strongest ever pushback against a weaker currency as it seeks to repair market confidence battered by weak data and credit fears. European stocks are lower. Bank of America warns investors prepare for a return to 5% world as the bond yields surge on bets that rates will stay higher for longer. And the great British summertime of cold and wet weather causes the UK retail sales to fall by more than expected. The pound has a damp start to the day. All the puns that you need to see you through. On The Pulse, this is State of Play in Europe, tracking the global equity markets lower. Are you a nervous bond trader or are you an anxious equity trader? That's the question that will be put out there, because the bond market is the tail that wags the equity dog. Volatility is back, peaking above 18%. The euro at the bottom of your screen is back to green at the moment, 108.75. However, I can tell you it dips below the 55-day moving average. You have this anxiousness in the equity market on the back of China. Is China really about to blow up? Have they lost control of the currency? Have they lost control of shadow banking? What is the size of the debt? What do you want to know? Roll it over, have a look at the cross assets, because those are the debates that we've had all week, and the consequences have been pretty significant. The bond market marches higher, and in part, you just come back ever so slightly from some of the highest levels that you've seen since 2007. Get ready. There's a new normal coming. 5% could be on the table in the bond market. Larry Summers says there's a new era coming. BlackRock are saying that there's a remarkable repricing to come at the long end of the curve. For the moment, 422, would you buy duration there? Bitcoin drops by over 4%. She tanked by 8% this morning. Volatility, I told you on Monday, was the lowest since 2016. Well, that's toast. So vol spikes in Bitcoin, the price implodes. Oil, skittish, 3% on such a bad week for China. Do you think that fairly reflects this scenario? Citi have a big call out there, short the oil market. The Fragile Five will deliver more supply. Let's dig deeper into the China story. The strongest ever pushback, it's a rebuke by any other word, against a weaker yuan as the authorities try to repair the confidence of, I suppose, the disappointing data, the heightened credit risks. Let's join Jill DeCease. She joins me now. What a week. The strongest fixing on record. Does it draw a line in the sand in the demise and the drop of the yuan? Good morning.
Good morning, Manus. Well, I think we've kind of been seeing lines being drawn in the sand when it comes to the yuan for quite a while, right? I mean, these fixings have been consistently strong. I'd also just point out, especially this week, we've seen so many different measures to try to support the currency, to try to assuage all of these concerns within markets, try to bolster confidence. But how much is it really working here, right? I mean, I literally have a list of everything that we've really seen from China, everything from mainland exchanges being asking investment funds to avoid net selling equities, officials asking state-owned banks to escalate interventions to support the yuan, and this is all, in the wake of just weeks of, the PBOC meeting with developers and other companies trying to say that they're addressing their financing needs, all of these different measures to try to shore up confidence within this economy, within these markets. And so far, I mean, you've seen the numbers today. I am not really sure how much of this is actually working. And for me, I'm also just looking forward to what's happening over the next couple of weeks and how that's going to affect markets and sentiment. Look, we've got PMI data out at the end of this month. If that slips even lower, I think that we have even further concerns for how much weakness there is here. I mean, obviously, we're also dealing with a strong dollar, remember, so that's part of the story here. But yes, it's certainly, there's a lot of concerns about the consistency and this weakness that we're seeing across the yuan, and I'm not really sure how much what we've seen so far from policymakers is doing to shore things up.
Yeah, well, there's certainly another assault that could come over the hill, isn't there, Jill? And certainly the strength of the dollar is one of those as the rates narrative holds higher for longer. Jill DeCease there on the very latest pushback from the Chinese authorities. Let's stay with that story. Mark Hayfley, long time since we've been together. He is the CIO of Global Wealth Management at UBS. Mark, good to see you. The pushback that you're seeing from the Chinese on the currency, if you were to frame risk in China through the prism of FX, I would be nervous. You're paid to be nervous for me. How nervous are you?
Well, I think that there's certainly reason for concern that's been brewing all year on a variety of fronts. But we know that China has been stepping up with measures, and we think they're likely to continue to step up with doing more. Not doing the shock and awe bazooka tactics of the past because they are concerned about still achieving some of the deleveraging. Uh, and meanwhile, if you look at the equity prices and other things, the valuations, there's not necessarily a near-term catalyst, but the valuations are, of course, extremely attractive.
Are they attractive enough to tempt you in yet, Mark, or do you want to see a few more issues clear the deck before you would step in there?
Well, I think that the way on the global strategy we're approaching this, on the equity side, is to acknowledge that China is part of the emerging market complex, and that we have India firing, and then these valuations. With the market, by many measures, kind of 40% cheaper than U.S. equities. We want to take a look at that even now.
Okay, and I see. Sorry, go ahead. Finish your thought, Mark.
No, that was finished.
I look at your asset allocation. You move equities to neutral from least preferred. So that's quite a pro-risk top-line narrative. But I want to focus on your bond position. Bonds stay our most preferred asset class, though the move to neutral on emerging markets. So let's focus on the bond aspect. I look at term premium. Term premium has now gone, the New York Fed term premium has gone from negative 1.6 to just under negative 0.5%. Is there enough term premium in there for you to step in and buy duration and to buy credit? Or are you in this 5% camp that Bank of America are wheeling at the moment? Get ready for 5% on bond yields.
Well, I think that because the inflation expectations in the United States remain anchored, we're not yet in the 5% camp. And, it's the middle of August, so it's a great time to release a new narrative out into the world. I mean, I think that we're approaching the peak in some of these rate hike cycles. And so we still think it's a good time to lock in yield here. And also, on the more investment grade side, on the credit side as well.
I love the title of today's monthly events. When elephants dance. I've been on a few awful dance floors with some awful dance moves myself. But when elephants dance, the mice get nervous. I think it's a very honest piece where it sort of says, like, you know what? It's easy to buy bonds, money market funds, and go, oh, mop your brow. But did you wish that you put a wee bit more into equities? I mean, talk me through, because it seems as if you're sort of almost torn in this piece this month.
Well, look, I think that the point is that we want to acknowledge that fears of recession, obviously, in the first half of the year didn't come to fruition. But there is this historic shift. The elephants of central banking hit the dance floor with new moves after 40 years of kind of rates coming down and doing whatever it takes to flood the market with liquidity. We have had a real shift. And I think that's where, neutral equity says, hey, we still have to see how some of this plays out before we can take sides in this, because the narrative has shifted and you have to respond to that. Doesn't mean that you want to disrupt your long-term investing plans. And the preference for bonds here is an acknowledgement that you can get these yields for many clients who have, are still thinking that we're going instantly back to zero. We're not going back to zero interest rates anytime soon. And so adding some bonds to your portfolio here can really help you to have a more balanced portfolio going forward in a variety of scenarios and new narratives that get launched into the world in kind of slow trading days in August.
And it's a very fair point. I think still most of the world is either somewhere on the Côte d'Azur, La Voile Rouge, with a glass of fine white wine in their hand, whereas I'm roasting to death in a 50-degree oven in Dubai, and you're in Switzerland. So if we look at risk, I've had a number of WhatsApps from people talking about Japan, the Ueda shock And they're benchmarking that to the Bernanke shock. You'll remember that, the taper tantrum of Bernanke. How do you look at Japan at the moment, Mark, from a global investment perspective? You must have the super rich speaking to you and saying, what portion should I have in Japan, or how do I expose to Japan?
Well, there's no question that the interest in Asia and Asia growth from global investors continues, and some of that has, of course, shifted from China towards Japan. And I think that for us, I think we're looking, of course, at the fine end of the spear, which is at the yen. And I think some of this yen weakness may persist longer, if only because the U.S. economy has remained so strong and probably is going to remain strong through the end of this year.
Okay, well, let's hope that all that recession talk does not come to bear. Mark, I'll leave you with this one data point as you unplug. The Hang Seng drops 2%. We're back in a bear market on the Hang Seng. Mark Haefele there, CIO for Global Wealth Management at UBS. And with that in mind, the pressure is bearing down on the Chinese equities. You just heard from Haefele, the global head of UBS, saying, yeah, at some juncture, you've got to look at the discount of China equities relative to the rest of the benchmarks around the world. But right now, Hang Seng falls to the lowest level since November of last year. The Hang Seng Tech closes down 3.6%, and it enters a correction. So the bulkhead is in a bear market and a correction in the tech sector. And tech has given up. It's the worst run of losses on tech, by the way, in the US that we've had in a number of months. Coming up in the show, we're going to dig deeper into those ugly retail sales in the United Kingdom. And what does it mean for the Bank of England? Right here on The Pulse this morning. Good morning. Welcome back to The Pulse, conversations that matter, the insights that you need on The Pulse. I'm Menace Cranny in Dubai. The bears are squarely in charge in China and in Hong Kong. The Hang Seng finishes the day in the bear market. The Hang Seng Tech Index closes down an additional 3.63%. Now that means the tech industry is in a correction. So at this juncture, you are just tracking on the back of US tech, which has had its worst three-day drop since February. But there is a great deal of anxiousness about the Chinese economy and the state of shadow banking. So those are your headlines on Chinese equities this morning as we close for this week in Hong Kong. Well, the pound is trading lower again this morning after the UK retail sales numbers came in. They fell more than expected in July. It was a cool and rainy month, and it kept people from the shops. Let's get to Katie Linsell. She is looking at the retail sales breakdown for us. Good to see you. What stood out for you?
Well, really, it was the fact that, very sadly, July was a bit of a washout for retailers. The areas that were particularly badly hit, I'd say, were clothing. Shoppers were thinking, why am I going to go out and buy a new outfit for that wedding or that holiday when I'm going to be sort of standing around in the rain? Other areas that came up as being particularly badly affected were DIY and also garden stores. People don't want to go out to a gardening centre and stand around looking at plants in the rain. So I think retailers really had a very tough time in July. When you pair that with the cost of living crisis and the fact that shoppers are already looking at their spend and really watching every penny, it created a very tough environment.
Yeah, and that's despite Asda, cutting the price of a whole range of products, over 200 products, and promising lower and better value. Katie, thank you very much. Katie Linsell there, our UK retail reporter. Now, we've mentioned it before, Japan is in focus. The core inflation number slowed in July, which is in line with the Bank of Japan's view that the upward pressure on prices is easing. However, there are pockets of sticky price growth that will keep the monetary authorities on the alert to the upside risks. For more, we're joined by Paul Jackson in Tokyo. Paul, I'm just looking at the data here. Does the cooling of inflation mean that we wait longer for the next move from the Bank of Japan? I mean, it's still, one should say, a 42-year high on excluding energy and fresh food, at 4.3%. So it's hardly gone away.
Yeah, I think what we're seeing here is a cooling that looks at first glance to be in line with the BOJ's view that prices will cool and that it must wait much longer to see if inflation is indeed sustainable. But what we're seeing is, you look into this data, are pockets of price stickiness that indicate that the risks are still very much on the upside. And let's be clear here, the central bank here has been quite a ways out on its projections. Only in April it was saying that inflation this fiscal year would average 1.8%. Well, we're a long way from 1.8%, right? We're still at 3.1 on the core measure. It upgraded that forecast up to 2.5 last month. So that's a big revision for a central bank that's supposed to know about all of this stuff. So inflation is cooling, but there's still quite a lot of momentum there. I don't think the BOJ can really relax while that figure that you mentioned, the one that excludes the energy prices, is still gaining momentum.
You're right. I mean, I think there are a few more sleepless nights. And I'm just looking at the overall report. If you think this time last year, if we just talk about those energy prices, because I think it's an issue for a lot of the central banks. It could come back to bite them in the second half of the year. On the headline, was it $80 in July is what we average, and yet this time last year we were around 105. So there's a lot of tension out there. Paul, thank you very much. Paul Jackson on the Japanese inflation. Coming up, Microsoft CEO Satya Nadella says AI is as big as the internet revolution in the 1990s. Our exclusive interview with the CEO.
Next week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
How transformative a change do you think this will be in how we work?
I think that probably the biggest difference maker will be business chat, because if you think about the most important database in any company is the database underneath all of your productivity software. Except that data is all siloed today. But now I can say, oh, I'm going to meet this customer. Can you tell me the last time I met them? Can you bring up all the documents that are written up about this customer and summarize it so that I'm current on what I need to be prepped for?
How do you make sure it's not Clippy 2.0? That it is helpful, delightful, doesn't want to make me click out ASAP?
Once they're under my control, the entire world will be subject to my whims. Go away, you paperclip! No one likes you!
There are two sets of things. One is,
You're laughing because
look, like our industry is full of lots of, examples from Clippy to even, let's say, current generation of these assistants and so on. They all are brittle. I think we are also going to have to learn that ultimately these are tools. Just like anytime somebody sends me a draft, I review the draft. I just don't accept the draft. We will do that.
in 1995, Bill Gates sent a memo calling the internet a tidal wave that would change all the rules and was going to be crucial to every part of the business. Is AI that big?
Yeah, I mean, in fact, I sort of say the ChatGPT, when it first came out, was like when Mosaic first came out, I think in 1993. And so, yes, it does feel like, to the Bill memo in 1995, it does feel like that to me.
So it's as big as the internet?
I think it's as big. It's just like in all of these things, right? We in the tech industry are, classic experts at overhyping everything. I hope, at least that what motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
How much market share do you think you can really take from Google? Like, what's your prediction? Give me your guts.
Are a real, I'm thrilled to be in search. We're a very small player in search, and I look forward to every inch we gain is a big gain.
There you go. The Microsoft CEO, Satya Nadella, in an exclusive conversation for Bloomberg's The Circuit with Emily Chang. And you can watch more on that interview of The Circuit with Emily Chang on Bloomberg Television Originals. So, let's have a look at what's going on in the oil market. You've had a lot thrown at it this week, haven't you? But we're set for the first dip since June. I think this is worth focusing in on. The average price in July was $80. This time last year was $105. But Citi have a brutal note out this morning. Supply is the angst of the oil market again. Prince Abdulaziz bin Salman is not going to be pleased to read this. We're hearing from Ed Morse and the team. Short oil. Supply climbs, demand slows. The supply will arrive from Russia and the Fragile Five, Iran, Iraq, Libya, Nigeria, and Venezuela. And don't forget, you're exaggerating the Chinese demand. Good morning. Good morning and welcome to The Pulse. I'm Manus Cranny in Dubai. This is the state of play. China delivers its strongest ever pushback against a weaker currency as it seeks to repair the confidence battered by weak data and credit fears. European stocks are lower. Bank of America warns investors should prepare to return to 5% world as bond yields surge on bets that rates will stay high for longer. And the great British summertime of cold and wet weather causes UK retail sales to fall more than expected. The pound has a damp start to the day. Good morning. It's turgid out there in Europe. By my estimate, this is down 2.5% so far overall for Europe this week. 3 weeks of losses, the longest run of losses since September. You're seeing some pretty big sector moves here. Industry goods down nearly 5%. Travel and leisure down 4%. Basic resources down 4% across Europe. This is the vicarious symbiotic relationship with China writ large. As China goes into a tailspin in shadow banking and in terms of growth and policy response and currency and capital exodus, so too global investors in Europe are worried because there is that huge industrial trading relationship between the two. Aberdeen down 12% in the UK. Retail sales trashed in the UK. It rained like Billy-O in July and you didn't go shopping. You did not go to the garden centre. This is a crime in English history. Let's have a look at the Hang Seng because as far as the Hang Seng is concerned, the Birds are back squarely in charge, down 20% on the headline Hang Seng. The Hang Seng Tech Index is in correction territory, which is down over 10%. There you go. Let's focus a little bit more deeply into the China story. State-owned property developers are warning of widespread losses. That fuel concerns that the housing crisis is expanding from the private sector to companies with government backing. Sophia Horta Acosta is with me. So they're worried in the bond market, they're skittish in the equity market, but they should be literally frightened as hell about China property market, shouldn't they?
Yeah, Manus, I mean, this was meant to be a kind of state advances, private sector retreat story in the property market. So the fact that even government-backed developers are struggling with wider losses than expected, and also not just a handful of them, but really kind of the whole sector, that shows me, Manus, that Beijing can't rely on these companies to kind of bail out the more badly run property developers like Evergrande and all of them that had really driven the crisis in the past 2 years. This is concerning. I don't want to use this word, but I think we have to. It's a contagion. It really is showing not just in the property market, but also developers. You're having financial contagion when it comes to companies that lend to the sector. You saw the trust fund defaulting earlier this week. So it's really, it really is escalating here, Manus, and it's not clear how Beijing will ring fence this.
I think one of the most surreal stories, Sophia, was that the police have turned up to ask people not to protest. This is one of the Bloomberg stories that we had yesterday, you know, over the past month, going to see people who have exposure to the wealth management products. And it's a very, very surreal story. I wish somebody would come and see me whenever the crashes come. Now, Evergrande, I mean, you're talking about property and you're talking about things that we've seen before. Evergrande, of course, first of all, that was back in 2021. That sent shockwaves through us. But I understand now it's only filing for bankruptcy protection now. Can you help me dissect that?
Yeah, Evergrande was really the first big domino to fall. And actually, markets digested that rather well at the end of 2021. We're seeing the fallout now. Why is it only filing for bankruptcy protection in the US? I think that's a really key question. Now, companies normally do this if they have US assets that they want to kind of shelter from a restructuring process. Evergrande has been under restructuring for a very long time now. Or they do this because they want to protect themselves from being sued by US investors. Now, because Evergrande doesn't really have US assets, we're thinking that it's more the latter. Evergrande has been trying to put together a restructuring proposal, but it doesn't have enough creditor support to really push this through. And that's the concern. That's really the delay here. So we're thinking that, you know, what would make sense is Evergrande seeking to kind of protect itself from angry US creditors who hold that dollar debt that has really kind of lost most of its value in trading in the past 2 years, because it's trying to push a restructuring proposal through, and it really has struggled to do so, Manus. This is the biggest ever private restructuring in China, so it's a very big deal. If Evergrande succeeds and manages to do this, it's a playbook, but it really hasn't been able to do this yet, Manus.
Yeah, and of course, will the billionaire owners of many of these property companies slip their hand into their own pocket to save the situation? That's a question as well. Sophia, thank you so much. Good to see you. Great reporting this week by you and the whole team on the China story. Sophia Hota e Costa. Now, on the outskirts of the Chinese city of Hangzhou, a small temple overlooks the graveyard of sorts. A series of fields where hundreds upon hundreds, literally, of electric cars have been abandoned among the weeds. And this comes after a subsidy-fueled boom that's driven China to become the electric car giant of the world. Dan Murtagh is one of the authors of today's Big Take investigation. Dan, good to see you. I mean, I had a guest here this morning from Hong Kong evangelizing his trip to China and how the EV revolution was there and how it was so pervasive. And yet you've got fields of abandoned EVs. Who's telling the truth?
Honestly, Manus, they're part of the same story. So for the genesis of the story we were telling, you have to go back about a decade to the infancy of the EV industry in China, when these cars had quite poor quality, to be honest. That you could only go about 100 kilometers on a single charge. They weren't very nice. They didn't have, great dashboards, all the nice stuff. And so the government, to help boost the industry, offered really strong subsidies. And you had big ride-hailing companies like Cao Cao and Didi who would buy, fleets of these EVs that they could, drive around, and then they could stow it and grab another car, let it charge, etc. And then you had the pandemic happen, and some of these ride-hailing companies went out of business. And more importantly, the sales that these ride-hailing companies made gave revenue to these EV manufacturers that allowed them to produce better and better cars. But what happened is now, these EV companies are coming out with great cars, 600-kilometer range, beautiful, beautiful designs, sleek, modern, what everybody wants. These old cars are basically obsolete, even though they're just a few years old. And so you have parking lots in Hangzhou and in other cities that are just filled with hundreds of them, and the companies can't find buyers, and so they're hanging on to them, waiting for them, and maybe trying to find a scrapyard and recyclers eventually.
And look, I mean, you've very eloquently outlined why they were abandoned. In other words, the COVID period, the businesses dried up. But what does it mean for that moniker, which is China, the leader of EV adoption? You see Tesla cutting prices in China, sequentially over the past, 2-3 price cuts this week alone. Does it still hold that level? We are the EV revolution of the world?
It really does, and your guest from Hong Kong this morning is absolutely right. If you're in a major city like Shanghai or Beijing and you order a Didi, half the time, if not more, you're going to get an EV in it. A third of all new car sales in China are now EVs. They're all the money for the best designs, the best performances. It's going into EVs. That's where the future is. But to get to where we are now, you had to go through this growing period of getting from the really poor quality cars to now. And that's what these graveyards represent. They show, what China does by throwing subsidy and throwing cash into a burgeoning industry. It can create some excess and waste, but it also creates the economies of scale that allow a business like EVs or like solar panels, frankly, very similar, to grow into the world-beating industry that it is.
Okay, Dan, there you go. The graveyards littered with EVs, but as you say, a whole new era came to birth. Dan Murder, it's a great big take. I suggest you hop on your Bloomberg in Beijing and globally and have a read. Coming up on the show, we're going to take a look at the jobs market. How are the working patterns shifting in a post-pandemic world? It's our exclusive interview with LinkedIn's head of global policy, global public policy, that is, right here on Bloomberg. Bloomberg has learned that Goldman Sachs has gone on a hiring spree to help address the concerns from the regulatory authorities, including the Fed. Sue Keenan has the very latest from New York.
Banking execs will tell you it's never good to have the Fed in your building and certainly not in your business. And sources say that is what's happening to Goldman Sachs. People close to the matter tell Bloomberg that several hundred new staffers are being brought on board to help address concerns from regulatory authorities, including the Federal Reserve. And this hiring binge is coming even as the firm has been cutting executives from the money-making ranks due to a slump in business. Now, Bloomberg reporting also shows there are now more openings at Goldman for compliance staff than for bankers. Now, while it's not unusual for large firms to face routine questions from regulators, Goldman execs have privately described growing pressure from the Fed over the past year. And this is a situation that's not ideal for banks because supervisors can impose increasingly formal and potentially onerous measures. Now, one source tells Bloomberg Goldman has been dealing with a confidential measure imposed by the Fed that predates the current increase in scrutiny. And while CEO David Solomon has been under a lot of pressure lately, including discontent among senior management at his bank, we're told that he has shared with colleagues that he believes the current situation is more reflective of a generally tough client for the industry in general. Goldman makes it a practice not to comment on regulatory matters, and they are not commenting at this time. Sue Keenan, Bloomberg, New York.
Sue Keenan there with the very latest on Goldman Sachs. Let's bring in an exclusive conversation now. We're seeing record wage growth in the UK, tightness in global labour markets, pretty hot US labour markets. So let's talk about the bigger trends in a post-pandemic labour market, which include, of course, working from home. Sue Duke is the Vice President and Head of Global Public Policy at LinkedIn. Sue, good to see you this morning. The big mega trends have been work from home, global flexibility, nomads. We now in Dubai are more popular than Lisbon, or for that matter, Dublin, for the global nomads. What is the evolution of these big mega trends in a post-COVID world? What's fading? What's popping? Good morning.
Good morning. Great to be here. The economic outlook looks uncertain, and so what we're seeing is that companies are pulling back from hiring compared to last year. Let's remember that that slowdown in hiring is coming off the back of the record highs we saw over the course of the pandemic, but there's no question but job seekers are starting to feel that uncertainty, particularly in the big markets, US, Canada. Here in the UK, we saw job searches increase 33% over the course of the past year. That said, it is a mixed picture, like you say. European markets in particular remain very, very tight, and businesses and sectors across the board there continue to see labour and skill shortages.
Tell me this. Who has the power? I mean, we're seeing record wage deals in the UK. And what goes through my mind, is it still the employee that has the power here? Or do the employers have a new optionality? They're pushing people back into the office. Who do you think's got the power?
Look, I think it's clear that we are starting to see a shift in that balance of power that we saw very squarely with workers throughout the course of the pandemic when we had that record hiring, when we had those acute shortages. That balance is starting to shift back to employers now, and we will continue to see that as this economic outlook remains uncertain across the world. That said, those patterns in work, hybrid, remote that you mentioned, what we are seeing is we do remain in a hybrid world of work. So what we see here in the UK, 1 in every 10 job posting on LinkedIn is a remote job, but 4 in every 10 is a hybrid job. So we see very clearly that employers are still ensuring that they're responding to the demands of workers to increase flexibility in the workplace and give back that work-life balance that workers sought so strongly throughout the pandemic.
When you talk to organizations, I mean, you are the head of policy, and here's the thing, you've got JP Morgan, Goldman Sachs, a lot of big banks saying, get back to the office. That's where the culture of collaboration and co-working works. And as you say, it could be maybe 3-2, it could be 4-1. It depends. Yep. From a policy point of view, what is the risk to Gen Z? I mean, I do have younger friends that are in Gen Z. It's hard to believe, but I do. And the point about it is, they've just said, not a chance, wouldn't even look at a job if it's not 3-2, 3 in the office, 2 at home. And I'm looking at them going, yeah, you haven't been through a brutal recession. You might change your mind at the end of it. What is the bigger answer to Gen Z?
One of the really interesting trends that we saw throughout the pandemic was this questioning of not only where we work and how we work, but why we work. And Gen Z were right at the forefront of there, really starting to ask themselves fundamental questions about what's the flexibility I want from work, what's the work-life balance I want to have in my life, and crucially, very focused on purpose-driven work. I want to work for an organization that not only offers me this flexibility, that it really cares about my work-life balance, but also values the things I care about. Green is a great example. We did a survey earlier this year, and fully 1 in 4 European workers puts the green credentials of an organization as their #1 non-negotiable when looking for a job. And again, Gen Z is absolutely at the forefront of that demand on companies that not only can they have that flexibility, but does this organization match the values that they hold so dearly?
Help me understand truth and fiction, that gender diversity improved in a pandemic world. We saw hybrid working, we saw the value to help and empower women to be more flexible and be, I suppose, involved in work, but yet at the same time splitting their time. Is that continuing, or is the brutality of economic risk putting a risk on the gender pay gap and the gender gap generally?
You've hit the nail on the head. Every time we see these systemic external shocks to the labour market, whether it was the pandemic or whether it's the economic uncertainty that's taken hold today, we see women take the biggest hit. That's true of layoffs, that's true of hiring generally, and it's especially true when it comes to the representation of women in leadership roles. We saw the progress of women in leadership go backwards, not stall, go backwards during the pandemic, and last year we saw it go backwards today. That means today only 32% of women are in leadership roles around the world, and we do not have a single country, and we do not have a single sector where we have reached gender parity when it comes to leadership. You're absolutely spot on. Flexibility is something that's absolutely key for women. We continue to see that women will apply for remote roles and hybrid roles more than men, but we have got to address these systemic challenges that we continue to face and put women in the most vulnerable spot when shocks hit.
Listen, far be it from me to even begin to comprehend, as a guy working in the Middle East, understanding the kind of challenges that is. But the graphic that we just showed, and I want to get your take on this. Women hold over 1/3 of the board positions in the S&P 500. Female directors have risen to 33.3%. And I would say, actually, Europe is way ahead. Europe is at nearly 40% in the boardroom. Australia's at 36%. And I grant you, the US is at 33%. May I just challenge what you've just said based on the data, and only the data, that I have in front of me? Is it as doomy and gloomy as you've just said to me, because the data that I'm looking at tells me something slightly different.
Of course, those numbers vary depending on the country we look at and the sector we look at. But what is undeniable is that when we look at the global picture, so when we look at the membership on LinkedIn, that's 950 million members based in every country in the world, what we see is that at entry level, we've roughly half female to half of the entry-level roles are women. When we get to leadership role, we're at a third. And when we get to that C-suite level, we're down to a quarter. So we're going from a half to a third to a quarter. And you see very clearly at global level that we see this pinching of female representation the higher up we go. They're the data that we see very, very clearly. And as I said, when we have these shocks, those numbers go further backwards. And that's what we need to shore up, particularly during this period of economic uncertainty.
There you go. That is a fine report. I got to say, I'm a big fan of the video function. Big fan. Love it. It's worth a couple of views on LinkedIn is worth a hell of a lot more than some of the other social media. Listen, Sue, thank you so much for being with me. That is Sue Duke, LinkedIn's head of global policy. An emphatic answer on women and their positions as they go through their career. The gender gap still has major challenges. Coming up, gambling on the World Cup, sports giants Nike and Adidas have got to decide, where's the merch? Where do I spend as we hunker in for Sunday's World Cup? Let's talk football. England meets Spain in the Women's World Cup. That is in the final on Sunday night. Millions of fans will be glued to the TV screens, and many are gambling on the outcome. Nike and Adidas, that is, over where to make the merch. Let's get to Oliver Crook. He's been tracking this. Oliver, it's a dilemma for Nike and Adidas, isn't it? You know, where do they put their money down? Do they even have the answer to this? Lovely tie, by the way. Good morning.
Thanks so much, Manus. Yeah, I mean, England versus Spain, but Nike versus Adidas, what unites them is this conflict of how much merchandise do you make. If you've got too much of it for the winning team, or you don't have enough, you've got a problem with investors or fans, maybe both. So how do they do this? You know, it's not an exact science, and this is sort of a problem, and they're very unforgiving, the fans. So you have a 72-hour window when something big happens and people want their jerseys. And so if you don't have them ready, you are in big trouble. So what do? They look at the historical data. The problem is with the Women's World Cup, you don't have that much historical data. And the other issue you have is the two teams here that are in the final have never won before. So you don't necessarily have that precedent baked in. The Adidas CEO going on saying, listen, there is not really a science here. If somebody could figure out this formula, we'll hire them immediately.
I take it you put your CV in then, Crookster. We'll leave you with that thought. Let's see who wins. The American in London, we should have asked him who he's supporting. So then it's the early edition. Kriti Gupta is up next from New York on Bloomberg.